Hello and welcome. You're watching Commodity Champions and I'm Manisha Gupta. Well, the Trump trade and tariffs. These are three words that have made commodity prices highly volatile in the recent months. Gold prices have hit all-time highs 6 times this year so far as concerns over the tariffs boosted its safe haven appeal. Copper prices are near record highs at a time when Trump is weighing tariffs on the metals imports. Crude prices are trading at a 3-week highs after Trump threatened 25% tariffs on countries buying oil from Venezuela. Come April 2nd, Trump is set to announce sweeping reciprocal tariffs on all trading partners of U.S. Remember, the U.S. already has imposed 25% tariffs on aluminum and steel imports from 12th of March. And this has led to countermeasures from Canada, Europe Union and China. While next week would be an eventful one, let's discuss what's in store for commodities during the rest of this year. Joining me now is Layton. He's Global Head of Commodities at Citi. Max, hi, thank you so much for being with us. I want to start with gold, and we've seen a string of all-time highs followed by some profit-taking right now. Where are the prices headed for the rest of this year, according to you?
Thanks, Manisha. Manisha. Thanks for having me on the show. We think gold price is going to keep going up. Bottom line is we're in the underlying drivers, the physical and we would say fundamental drivers of this gold bull market remain in place and will continue to drive gold all the way up in our base case to $3,200 an ounce over the next couple of months, and then potentially up as high as $3,500 an ounce if we're in in more of a concerning U.S. growth environment than what we have in our base case.
Max, also, where do you see all of this buying coming in from? I mean, we do understand that the central banks are buying and ETF buying has also been quite strong. The kind of gold that we've seen being shipped from UK to US is yet another story. But to take the prices from where they are to 3,200 and 3,500, where is this new buying going to come from?
Yeah, I think you've named all the core recent drivers. We think a lot of them remain in play. In particular, President Trump and his team, they've mentioned some pretty high headline tariff figures on April 2, on Liberation Day, as President Trump's calling it. And these kinds of tariffs, if delivered, even if half of them are delivered, are going to be concerning from a global growth perspective, but also from a US growth perspective over the next 3 to 6 months. So that would kind of cement, in our view, a continuation of what we've seen over the last couple of years, which is a very gradual slowing in US economic growth. Around that, in the past, we've tended to see savings rates rise, ETF demand rise alongside that, with the driver of both being precautionary savings from households. And we think this is kind of going to take you that next leg higher over the next quarter or two.
Max, also, what is your sense on the silver prices? Because the prices have had strong fundamentals, the industrial demand deficit, but we haven't seen $34 an ounce break on the higher side. How are you looking at fundamentals and the price move from here?
Yeah, I think stepping back, this silver price is fantastically high versus mining costs relative to, even if you take a 50-year silver chart, this is a pretty high price by historical standards. So silver's done well. It's doing well. It's up. It's trading in the low 20s a bit over a year ago. So the price is doing extremely well. It perhaps has disappointed some of the kind of stronger bulls. It hasn't exactly significantly outperformed gold. So it hasn't been the leveraged kind of play to gold that a lot of people were looking for. And really that all comes down to the soft global growth environment. So we think silver, it's got a lot of exposure to a bigger than expected China easing, for example, or and it continues to kind of probably give you roughly the same, maybe less return than gold over the next couple of months. I think the thing that's stopping us getting super excited about silver, and we are modestly bullish from these price levels over the next 3 to 6 months, getting up to $34, $35. The thing that's stopping us is this tariff threat from President Trump. So less tariffs than expected, together with some China easing, and silver can come in more in line with our bull case scenario towards the $40 mark.
How are you also looking at the US dollar index? Because it's come down from 110 plus kind of levels when we started this year to almost 103. Would you look at the currency in the light of fundamentals that you talked about in the US, and what would that mean for the dollar index?
Yeah, I mean, currency's, notoriously difficult. There's a lot of different moving parts, especially with the dollar, and I kind of defer to our currency team on that one. I don't think they have a particularly kind of super bullish or super bearish stance from these levels. It's very difficult to have a high amount of conviction considering the range of tariff outcomes. I would say that's going to come down upon the global economy, potentially as soon as in less than 2 weeks. Overall, I would say that it's extremely rare historically that you have a very, even though dollars come down, it's still relatively strong. It's extremely rare you have a strong dollar, a relatively strong dollar. It's extremely rare you also have high interest rates at the same time as gold is printing all-time highs. This combination is highly unusual, and it's resulting in an extremely large contango across the gold curve. So we're highlighting to our clients, for example, that in 5 years forward, gold is already trading at 3,600 plus per ounce, which is essentially a gift for the gold producers. And it's a gift that is not given in other commodity markets to other commodity producers. When prices are at all-time highs, they're typically in backwardation, or at best, a flat curve. Gold is printing a 4% per annum contango, rising to 20% in 5 years' time, which is, in our view, a remarkable kind of gift and a potential opportunity over the next 6 to 12 months for miners to take some insurance that gold isn't 3,600 in 4 or 5 years' time.
All right. Let's talk about the copper prices now and the kind of run-up that we've seen here. 12% up on LME, 25% up on COMEX. I mean, Max, when was the last time we saw something like that, this huge disparity in prices?
Yeah, what a run. I mean, it's kind of reminding us of the copper price action we saw a bit over 12 months ago, which was the strongest in years and years, certainly since 2020, 2021 out of the COVID recovery. And yeah, what I find amazing is you've had 3, 4, 5,000 years of gold building above ground in the gold market, and the gold market has been tightened by the shift of metal from ex-US to the US. So the gold market ex-US has been tightened. Gold market has a 50-to-1 stock to flow ratio, whereas copper, it has a very low stock to consumption ratio. It's like not the inverse exactly, but essentially the opposite of gold. So if gold can get tightened by the shift of metal due to the threat of tariffs, and it has this massive above ground stock, just imagine what can happen in copper over the next couple of months. So I think this kind of tightening that we're seeing in physical markets across precious metals and copper, any commodity that's trading CME and has a liquid ex-US kind of contract, you are seeing this big shift of metal to the US, and it's tightening things up, and that's most likely to continue for the next couple of months, and is kind of why we upgraded our copper forecast to 10,000. We're already there, and obviously there's potential for that to go higher. Reason why we haven't gone with a higher number is just because we're expecting pretty sizable tariffs on April 2. So you've got this kind of medium-term demand potential shock to the downside, at the same time as you've got a really tight and tightening physical market. And so, it's not like both are going in the same direction. So, we didn't put in higher than 10K.
All right, Max, not yet, as you said. But when it comes to aluminum and steel, where we already have seen tariffs and the premium that the US metal seems to be commanding, what is the best case scenario for these prices by the end of this year? And also, how would you look at zinc or iron ore, where we already have seen some profit taking, kind of underperformance, by the way?
Yeah, so I would kind of distinguish copper and aluminium from zinc, for example. So copper and aluminium really don't have much supply growth. Copper on the mine supply side, aluminium on the smelter supply. Um, we they're I wouldn't say X supply growth, but China's been driving the supply growth in aluminium for almost 20 years or 20 years, and that's pretty much drying up. On the copper side, it's tough to mine copper, and it's become more and more expensive and more difficult. And we're seeing that with both disruptions remaining elevated, despite analysts seeing disruptions every single year. We still over forecast copper supply every year for pretty much the past 20 years. And this year, is kind of no exception. The supply is coming in lower than expected again on the copper side. So I think copper and alloy, although we have them coming down temporarily for the second half and then having a strong 2026, they're supported. Their prices aren't going to be as low as historical lows in growth slowdowns. So obviously 10 years ago we saw a big growth slowdown, a deflationary shock, and copper got down to $4,000. This is not going to happen again. I could be eating my words here, but I think that's highly unlikely. Similarly, in aluminium, it got down to $1,400 in the previous down cycle. This time we just don't have the supply growth. And secondly, we've got very strong energy transition demand related growth coming from China, which is absorbing whatever supply growth there is, which is not much. So we didn't build much inventory in the last couple of years of weak cyclical demand growth. So for all these reasons, I think they're going to go down, but not that much over the next six months or so associated with the pretty strong tariffs that we think are coming. And then on the zinc side, we think that will go down and underperform. That it's the big underperformer, and the reason is the next 12 months there's a lot of zinc supply, mine supply coming on.
I also want to shift focus to the energy space, and the International Energy Agency's recent report talks about how global energy demand grew by 2.2% in 2024. While we have seen growth across energy, whether it's oil, natural gas, coal, or even nuclear, but the highest investment and demand came in from renewables at 35 to 38%. How would you look at the energy and the crude prices going forward?
Yeah, I think from a longer term perspective, we've obviously seen a slowdown in oil demand growth, both outright and certainly relative to GDP. That's something we very gradually expect is going to continue over the next 5 years or so. Having said that, we are on the supply side seeing some signs that sustained high levels of capex in the US is not resulting in kind of constant growth in supply. We're seeing a slowing in US supply growth, particularly for crude oil. And so there does look like over the medium term that there is some increasing room for OPEC Plus to return barrels to the market. Now, we think this dynamic, certainly for the next year or two, as the barrels are returned, means that we're going to be in a $60 to $75 Brent range over that period. But certainly, kind of medium to longer term, there is room for those OPEC barrels to come back, in our opinion, and it's created by shale, essentially, growth slowing down. Now, we don't see flat or negative demand growth in crude oil over the medium term, and we don't see negative shale oil supply growth either. Overall, this market looks kind of like the right price is in that $65, $70 bracket.
A final question then, and since we've spoken so much about tariffs, Max, going forward now, what is the worst case scenario or the best case scenario when it comes to tariffs going forward?
I would say one of the worst case scenarios is that the reciprocal tariffs that U.S. Commerce Secretary Lutnick said that their finding was what would raise $700 billion, that those are enacted fairly immediately, and that those are not redistributed. On top of that, that you have a higher headline number than the $700 billion because you want to, because the administration might want to negotiate down from an even higher number. So kind of worst case scenario for me on April 2 is a 15 to 30% tariffs across the vast bulk of the imports, implemented immediately and not redistributed to people, either through no tax on tips or to kind of middle income and lower income people on incomes less than 150,000 US dollars. I mean, if that happens, that's the worst case scenario. I think the best case is for me is something like 5 to 10% tariffs, which would still be a pretty big headwind for global growth, in my opinion. And for metals and commodity markets more broadly, and that they are kind of either phased in, or industries with complex supply chains are given time to phase in, and that the revenues raised are near immediately redistributed. That would kind of minimize the impact of the shock. On top of that, China and Europe stimulate to kind of offset the impact on their economies. And in that scenario, I think you can be looking at what U.S. Commerce Secretary Lutnick mentioned about President Trump and their team owning the economy from the fourth quarter of this year, which would be essentially that the fourth quarter growth outlook is better and even better into 2026. So that's probably the best case, and even then we've got some pretty serious adjustment to global trade coming over the next 3 months.
All right, that's interesting, Max. As you said, 5 to 10% perhaps in the current scenario would be a best performance, and 15 to 30% would be a worst scenario when it comes to tariffs. Reciprocal tariffs is what we're talking about on 2nd of April. So a week to go to that, and that is what could really change the international markets there. Max, thank you so much for joining us. And with that, it's time for a break. But don't go anywhere. We will throw the spotlight on several Indian jewelers and their outlook on the year on the other side.